Thank you for trying financetrainingcourse.com, an online collection of risk, Basel, treasury, and portfolio management resources created by risk and treasury professionals. Hello, and welcome to our session on Asset Liability Management, or ALM for short. ALM is a topic that is of interest to any institution that is in the business of raising money from its customers and using that amount or the proceeds to going out and purchasing assets that would then go ahead and generate interest income. It's a topic that's best illustrated by an example, and that's exactly what we're going to do. So let's start with the case of Bank A. Bank A has been lucky enough to raise about $10 billion in equity from its shareholders. Using these $10 billion as a base, they've been able to go out and generate another $90 billion or so in deposits from their depositors, and have then gone out and used the combined amount to purchase assets worth $100 billion US. Now, if you look at Bank A's model is very simple. Bank A goes out and raises equity, let's say at a cost of about 12%. It goes out and raises deposits from the market at, let's say, a rate of 6%. And it is able to then invest the proceeds or use the proceeds from these two sources into writing loans on which it earns a return of 12%. So if Bank A takes a slice of $1 billion from here, from shareholders' equity, remember this billion costs them 12%, so for a year this usage is worth about 120 million. And then combines this with another slice of 9 billion from liabilities, and this 9 billion costs it 6%. So 9 billion into 6% will give you a total amount for the year of about 54 million. Right? So the total cost of this pool of funds is about 174 million. Okay? And in return, what the bank then goes out and generates is a slice of 10 billion, and on this slice bank is able to book a return of 12% for a total amount of 1.2 billion. Sorry, my mistake. This amount is not 54 million, it's 540 million, and the total amount then becomes 660 million in terms of costs. Alright, so in this specific scenario, what the bank is basically doing is that it's taking money from here at 12%, money from here at 6%, and then going out and lending the entire amount at 12%. And the total profit that the bank generates using this method then becomes the difference between 1.2 billion, which is the interest earned on this asset, less the amount that they've paid in terms of both interest as well as expected dividends to shareholders. And the net return then becomes 1200 minus 660, which is a return of about 540 million US dollars on just this specific portfolio. So a number of questions come up when we work with this specific example. The first question that comes up is that all of this is fine and well as long as the maturity of this deposit. Equity we're not concerned about, because our assumption is this is something that will mature only when the bank is liquidated and shut down, and if there's anything left over for the shareholders to get paid. So if the maturity of this note is about 1 year and the maturity of this loan is 1 year, then we're in good shape. And the reason why we're in good shape is because as soon as or just before this loan matures, we get repayment and interest from as soon as this deposit matures, just before that we get the proceeds from the maturity of this loan, and we simply take this money and return the amount to the depositors and the remaining 1 billion slice to our shareholders, and that's that. for a reasonable, actually quite respectable return of about 540 million on the amount or the slice that has been assigned and allocated. So the question that comes up is, if 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 this is all that's required, why is there such a big fuss? So to look at an instance of an example where this fuss actually occurs, let's do a slightly different variation. And in this variation, let's think about a scenario where it is possible for us to be in a situation where both deposits, the 90 billion that we had here, and assets get repriced. And now, rather than looking at Bank A, let's look at Bank B. So what Bank B did, same structure, same performance, is that it takes the entire amount, just 10 billion here, just 90 billion here, and uses this to go out and purchase a 10-year bond. Okay. Unlike a loan, this is a bond that goes up and comes down in value. And in terms of the liability that Bank B used to fund this asset, the liability was a 1-year deposit. So the question that comes up in front of us is that interest rates, the determinants of especially the value of a 10-year bond, and at times depending on who you ask, the value of a 1-year deposit, are not constant, they're not static, they change, they go up and come down. So let's say that when this structure was created or when this investment was made, the 1-year deposit, the primary liability that Bank B was using was priced at, let's say, 10%. It's priced at 10%, and the 10-year bond was priced at 12%. And at 12%, the 1-year bond was worth exactly 100. At 10%, the 1-year liability was worth exactly 90. Now, assume a world where interest rates go up and down, and it is possible for you to reprice both assets as well as liabilities. And when the repricing happens, let's assume that interest rates go up by 2%. They go up by 2% here, they go up by 2% here. When repricing happens, you have another very interesting concept that comes into play, and this concept is, I'm just going to mark it here for safekeeping, and this concept is duration or interest rate sensitivity. IRS gets used for a number of other terms, but here we are referring it to, here IRS refers to interest rate sensitivity or interest rate elasticity. How do prices change when rates go up and come down? So we actually have a separate course on duration and convexity, and if you look through the end of this course, you'll actually see a reference to a link or a video link which is incorporated in the course on understanding duration and convexity. I'd highly recommend that you take a look at that before you proceed further from this point in time. But for a second, let's assume that we understand what duration and convexity is, and for ease of reference, let's say duration represents the change in the price of a bond when rates go up and come down. So let's say that a 10-year bond has a duration of 10%. Crude approximation, very, very crude approximation. So if rates go up by 2%, we are saying that the interest rate bond's value will change by plus minus 20%. If rates go up, the value will come down by 20%. If rates come down, the value will go up by 20%. Which means that our 10-year bond, this 100 billion inventory of the 10-year bond, is now worth not 10-year, but not worth 10 years, but is now, this 100 is now worth only how much? 20% reduction in 100 is now worth 80. Now if you look at the liabilities, on the liability side we have a 1-year deposit. Let's also assume that it's possible for us to reprice this deposit, and the value of this deposit at the end of when rates change goes from it goes from 90 and it comes down by the amount that this deposit will change. Let's assume that the duration or the interest rate sensitivity of this deposit is, because it's a 1-year deposit, it's only 1%. So if rates go up by 2%, this deposit pool is now worth 88 from 98. Right? So here's the situation. The situation is that you had, when you started off, your equation was assets equals liability plus equity. If you move liability to this side, this equation changes and this becomes assets minus liabilities equal equity. Right? So I've just simply added a minus L here, minus L here, and the two cancel out. So in the beginning, when we started, we said, we have a balance sheet where I have 100 billion in assets and I have 90 billion in liabilities, and that gives me an equity base of 10 billion. When the situation ended for bank B, we have a scenario where I have assets worth 80 and my liabilities are still worth 88. And I'm now in a situation where I actually have a negative equity of minus 8. So as a bank, I've basically gone under. I'm no longer able to function. There's a very good chance that even before this exercise or this incident happened, my central bank has possibly shut me down so that they can protect the interest of my depositors. So compared to the scenario that we covered earlier, which was the example of the loan, we had perfect matching. We had perfect matching between a 1-year deposit and a 1-year liability. And as soon as the asset matured, we were able to repay our banking customer. In our second scenario, which is here, in the second scenario, things are not that rosy. In the second scenario, from a pricing point of view or a maturity point of view, we actually made a mistake. And that mistake was that we used a 1-year deposit to fund a 10-year asset, and that led to a situation where that when rates moved against us and went up by 2%, the equity of the bank was wiped out when this asset was repriced and when this liability was repriced. So in short, what you've just seen is a very simple, very quick, very brief application of ALM. And in this application, the focus has been on what we call interest rate mismatch. And the interest rate mismatch occurred because the tenor, the maturity or the duration of the assets was significantly greater than the duration or maturity of liabilities. And it was this mismatch that created the situation or the scenario where the bank's equity was wiped out when interest rates moved against us and the underlying assets and liabilities were repriced. So this in essence is the concept of asset liability management. Now, from an application point of view, there are actually a wide range of concepts, questions, and applications that are related to the subject of ALM. And if I were to go through them very, very quickly, especially based on what we've just looked at and just covered, the first question deals with what is the right maturity, or in banking terms, what's the right maturity gap? Difference between the maturity of my assets and the maturities of my liability. Question number one. And this maturity piece comes into play for a wide range of reasons. Second thing that comes into play again here is that the reason why you take this gap, the reason why banks are in the business of taking gaps or go out and take this risk is because let's say I have a scenario where on the 1 year, the 3 year, the 5 year and the 10-year deposit, I can raise these deposits at 6%, raise these at 9%, raise these at 11%, raise these at 11.5%. And from an asset point of view, I can buy or invest or acquire a 1-year asset and earn a return of 8%, a 3-year asset and earn a return of 8.5%, a 5-year asset and earn a return of 11.5%, and a 10-year asset and earn a return of, let's say, 13%. So from a gap point of view, one of the reasons why I take a gap is because I want to borrow at a point where my pricing and costing is low, and lend at a point where my pricing and earnings are high. And this gap of about 7% is what would go straight into my interest spread or margin. So this gap-based model would work as long as, see, this is my asset, right? So that's the asset that we bought. So at year 0, time 0, I went out and acquired something worth $100, which I will only get paid at the end of 10 years. So let's say this is 10 years, at the end of 10 years. And in the interim, I've gone out and funded the purchase of this asset by borrowing money for a year. So at the end of the first year, if I'm still able to raise money at 6%, I'm good. You know, I earn 6%, so I pay 6% to my depositors, to my customers, and I earn a return of 13%, so I lock in a spread of 7%. And then the second year, and then the third year, and then the fourth year, and then the fifth, sixth, seventh, eighth, ninth, and 10th. If anywhere in between, the cost of this deposit becomes 13% or higher, I have a losing trade. Or if this deposit is not renewed and I have to sell these assets, I have to sell this 100 billion worth whatever it is at this point in time, then I have an issue. So from a gap point of view, there are instances and there are occasions where the interest rate environment, this is the interest rate environment, where the interest rate environment suggests that we should actually maximize the gap. And there are instances and occasions and times where the interest rate environment suggests that we should actually minimize this gap as much as possible. To a large extent, the decisions and the work that we are going to do in this course will focus on questions and themes along the lines of what you've just seen. Now, in terms of an ALM framework, so if we think in terms of an ALM framework, there are three primary areas of interest. The first is what we call exposure. The second is what we call risk, and the third is what we call target accounts. And let's look at each of them one by one. So what is exposure? Exposure within an ALM setting as well as within a risk management setting refers to the size of your book. So I have 90 billion of liabilities, Bank A as well as Bank B. I have 100 billion in assets, both Bank A and Bank B. I have 10 billion in loans. I have 90 billion in securities and investments, especially the 10-year bond. So all of this is referred to what we call exposures. The interesting about exposure is something that's completely driven and set by the policy decisions that we've made with respect to whether we're going to lend in the credit markets, whether we're going to buy short-term bonds or long-term bonds or medium-term bonds, as well as our decisions to fund these acquisitions and purchases and asset purchases by either short-term or medium-term or long-term deposits. Once we have exposures, a breakdown of assets and liabilities and maturities across products and choices and allocations, next question we ask is, given these exposures, so given these numbers that we've just marked out here, what is the probability, what is the chance that we may actually suffer a loss of capital? But in addition to this loss of capital, what is the probability that we may suffer such a big hit, as this was the case for Bank B, that we may actually go under, or we may be shut down, or we may fail as a bank? And one way of looking at this probability is you can say, okay, what's the chance that the bank will fail? what's the chance that the bank will fail and go under? Or you can actually say that rather than looking at probabilities, I want to go out and restrict or limit um, things like interest rate sensitivity, things like short-term gap, things like long-term gap, things like the amount that my interest income changes when interest rates go up or interest rates come down, or the amount by which shareholders' equity changes when interest rates go up or come down. So an ALM target account is basically a mechanism of measuring this exposure in such a fashion that you incorporate the impact of interest rate changes going up or coming down directly into these numbers. And the reason why you do this is because you use this as a tool for keeping an eye on this risk. This set of numbers that we've just spoken about are numbers that we use primarily to ensure that our bank or our people or our teams do not book exposure at a level where the bank will fail or may possibly fail. So if I were to summarize this, you're effectively saying that one part of the ALM framework is the choices that we make in funding asset purchases. So am I going to fund it by deposits? Am I going to fund it by short-term borrowing? Am I going to fund it by interbank borrowing? Am I going to fund it by shareholders' equity? That's one part, right? Second part of the framework that we're dealing with within ALM deals with maturity. So both in terms of assets and in terms of liabilities. Am I going to buy a 10-year asset, a 5-year asset, a 3-year asset? Is this asset going to be a loan or a bond? Am I going to fund this asset by a 1-year deposit, a 6-month deposit, a 3-year deposit, or a 5-year deposit, or possibly even a loan or an amount that I've actually borrowed from markets in the form of either listed corporate debt or a capital note or a bank linked note or a bank guaranteed note or a holding company note. So two pieces, one that deals with funding, how am I going to fund my assets, and what maturities I'm going to use with respect to funding these assets. The third piece that comes up within the framework is what's my outlook on rates? Are rates going to come up or go down? Depending on my outlook on rate, I would actually go out and make choices. So the difference between the maturities of assets and liabilities is, for now, let's just call it gap. Based on my outlook of interest rates, I may take decisions that may have a direct impact on the gap that I run. And the gap that I run has a direct impact on the income that I realize based on the mismatch caused by the gap. So which means, in addition to funding and maturity, I need to actually have an outlook for rates and actually have some understanding or some assessment of how this outlook on rates drives choices here and how these choices drive income. And finally, the last and final piece is when it comes to repricing. So interest rates go up. What is my interest rates go up? What is my bond portfolio worth? What is my loan portfolio worth? What is my deposit portfolio worth? And can I actually mark to market these or not? So within the framework, you're saying funding decisions, maturity decisions, interest rate models and outlook, and repricing of securities. Together, all of this has an impact on two very crucial pieces. The first piece is value. So how does the interaction of all of these, 1, 2, 3, 4, all 4 parameters, how does this have an impact on shareholder value of the bank? So this is the instance where bank B started with 10 and ended up with -8. Okay. And the second is what's the impact of income. We haven't spent a lot of time on income, but in a very simple sense, if rates are at 10% and you make a choice of buying or investing in a 1-year loan versus a 10-year bond, what's the net difference between the amount that you have to pay to your depositors and the amount that you will receive in terms of interest income? Okay. So the primary framework with respect to asset liability management looks at the impact of a range of external factors on value and income, shareholder value and interest income. And that's the framework that we'll carry on using with respect to our analysis. So if I were to slightly formalize this, what I'm basically saying is that my target account or metric is something that determines the change in interest income for the bank and the change in shareholder value. And the driver is change in interest rates, and the setting is balance sheet for value and income statement for interest income. If I can put something in place that allows me to measure this on a stable, consistent, very bad, stable and consistent basis. All right. So if I can put this in a framework that allows me to measure all of this on a stable, consistent, and measurable basis, I actually have a framework that I can work with. Now, you can't stop here. You actually need to figure out who gets to see what. So you need to figure out from a reporting point of view who gets to see what. So think in terms of teams that run a bank. So each bank has a group that is responsible for lending money to customers. So let's call this the corporate banking desk. And there's another group in the bank that lends money to consumers. So let's call this the consumer banking desk. Then there is a treasury desk. This is the desk that takes care of the ALM needs, the ALM decisions, the funding needs, the financing needs, the liquidity needs, as well as on occasions goes out and makes what are called proprietary trading decisions on account of the bank's shareholders. So it uses bank's capital to go out and make trades and uses that, the result or the income generated from those trades, to supplement its income. Right? Then there is a group which is, let's just call this the risk group. And then there is a management committee or an executive committee, and then there is a board, and within the board there are further smaller subcommittees that look after specific functions. So somebody who's sitting at the consumer bank, somebody who's looking at the corporate bank may not necessarily have all the relevant information with respect to the outlook of the market, with respect to the outlook of the interest rates, with respect to what the competition is or is not offering. And hence these guys are actually reliant on the specialists that sit in the treasury function. And the treasury function specialists basically go out and throw what we call a pool rate. And it's this pool rate that is used by these guys here and here for pricing purposes. Now, who looks after these treasury guys? The group that looks after these treasury guys is the risk group, which ensures that the various target accounts that we've just spoken about are tracked, that changes in these target accounts are measured on account of both the current as well as the outlook of rates, and that these are reported. And these are reported both downwards, reported sideways, and reported upwards. And upwards also to the board as well as to the various subcommittees that run the ALM function. But the level of detail that gets reported is very, very different. When I'm sending pool rate information out to these guys, they're primarily interested in what are the drivers that drive the rate that I used to get that I use to cost and price my exposures and my instruments. When they send information sideways, this information's primary purpose is to make sure that operationally everybody's in the loop with respect to what's happening. And when it goes to the board and the various risk committees, it goes out in a very simple, very summarized, short form basis. And the objective sometimes when you engage the board is to inform and keep them in the loop. Sometimes is to take consent for something that you're about to do. Sometimes is to make them aware of the exposures and the risks that the bank faces based on a change in outlook, based on decisions made from an allocation point of view here, and on occasions based on decisions that will be made if a certain change in policy goes through. So in terms of reviewing what we've just done, we introduced the concept of the fact that a bank has assets and liabilities and makes certain choices with respect to those assets and liabilities that drive to some extent the chance or the probability of failure of that bank. And one way that we track these probabilities is by understanding the difference between the exposure the bank carries here, the risk that the bank carries based on account of the exposures that we've just recorded and documented here, and tracking both the risk and the exposures by using target accounts. And the essence of those target accounts that we spoke about are accounts that focus on funding choices, accounts that focus on maturities, accounts that focus on the impact of interest rates, both in terms of shareholder value and repricing of our bond portfolio. And we finally came back to the concept of how a given target account is driven or defined or impacted by a change in interest rates, and the setting of the target account with respect to whether it's something that is tracking what's happening on the balance sheet or tracking something that's happening on the income side. And then we finally closed it with a quick review of the reporting structure that's in place. Reporting structure both in terms of information that gets reported to people who work in parallel or in tandem with the treasury team, people who work in parallel with the function, both the risk team as well as the management committee, and the information that goes out to the board. For us to move forward beyond this point, we actually need to go out and introduce a number of core topics and themes, and these core topics and themes deal with some key definitions that get used in the ALM function. So in our next session, when we come back, we will start with a review, a very quick review of the topics that we just spoken about, and then if we have time, take a look at some sample reports and the functioning and the working and the logic of those reports. For today, this is where we'll end and finish. I hope you've enjoyed yourself. This is Jawad Ahmed Fareed signing off for financetrainingcourses.com. Thank you very much for your time.